Every day, millions of events unfold that could lead to loss, from car accidents to natural disasters. Life is unpredictable. But what if there was a system that could provide protection against the economic impact of such losses? Welcome to the world of insurance. But first, a brief history. The concept of insurance isn't new. It dates back thousands of years. Ancient merchants sought ways to limit losses when shipping goods. They formed agreements that, should one ship be lost, the cargo's loss would be shared among several merchants. Chinese merchants, circa 3000 BC, also developed a form of risk management. When sending their goods along treacherous river routes, they'd distribute their wares across several boats. This method meant that if one boat capsized, the loss wouldn't be total. One of the earliest forms of insurance was practiced in ancient Babylon and was recorded in the famous Code of Hammurabi, circa 1750 BC. Merchants who obtained loans to fund their shipments could pay a premium to lenders to ensure their loans wouldn't need to be repaid if the shipment was lost or stolen. Ancient Greece and Rome adopted early forms of insurance and extended them beyond shipping. Funeral societies in ancient Rome, for instance, collected monthly dues and then provided burial costs for deceased members. By the late Middle Ages, craft guilds had become prevalent in Europe. These guilds, groups of artisans and craftsmen, provided their members with protection against poverty, sickness, or death. The 14th century saw the growth of marine insurance in the Italian city-states, notably Genoa and Venice. Policies were drawn up, detailing the terms and conditions of the risks covered. The Great Fire of London in 1666 highlighted the need for fire insurance. After the fire, Nicholas Barbon introduced the first fire insurance and established the first English insurance company, the Insurance Office for Houses, in 1681. From these early beginnings, the concept has evolved into the multifaceted industry we recognize today. Insurance operates on the principle of risk pooling. Multiple policyholders pay premiums to an insurance provider, and in return, the provider takes on the financial risk of certain covered events. Since not all policyholders will claim at the same time, or even at all, this system works by distributing risk across a larger group. In essence, insurance provides a cushion against unexpected losses by pooling the risks of many to benefit the individual. It's a financial arrangement that provides peace of mind and security in a world full of uncertainties. There is no single definition of insurance. Insurance can be defined from the viewpoint of several disciplines, including law, economics, history, actuarial science, risk theory, and sociology. However, a definition of insurance that captures the essential characteristics of a true insurance plan gives the Commission on Insurance Terminology of the American Risk and Insurance Association. According to the American Risk and Insurance Association, insurance is the pooling of fortuitous losses by transfer of such risks to insurers, who agree to indemnify insureds for such losses, to provide other pecuniary benefits on their occurrence, or to render services connected with the risk. In simple terms, it's about gathering resources from many to compensate the unfortunate few who experience loss. Economically, insurance supports businesses and individuals by providing security. It stabilizes commerce and encourages entrepreneurs and individuals to take risks, knowing they have a safety net. At its core, insurance is an economic system for spreading risk among many participants. By paying premiums into a common fund, a large group of people can share the economic consequences of similar risks. Insurance fosters economic growth. Businesses can undertake higher risks, knowing potential losses can be covered. This encourages innovation and expansion. Premiums collected by insurance companies contribute to the national savings pool, which can then be invested in various sectors of the economy. Insurance provides businesses and individuals a financial safety net, ensuring that catastrophic events don't lead to economic downfall. Legally, insurance is a contract. It binds the insurer to compensate the insured if a specified event occurs, in return for a fee known as a premium. It specifies what risks are covered, the cost of the coverage, premiums, and the obligations of both parties. Both the insurer and the insured are bound by a principle of utmost good faith. For a contract to be valid, the policyholder must have an insurable interest in the risk they're insuring. For instance, you can't insure a stranger's life just because you feel like it. Except for life insurance and a few other types, insurance contracts are contracts of indemnity. This means they aim to restore the insured to the financial position they were in before the loss. Insurance industries are heavily regulated to protect consumers, maintain industry standards, and ensure financial stability. Actuarially, insurance is about calculating risk. Actuaries use mathematics, statistics, and financial theory to study uncertain future events. Their insights help insurers set premium rates and ensure financial stability. After the introduction of basics of insurance, let's explain the basic characteristics of insurance. First, pooling of losses. By gathering premiums from many clients, insurers create a pool of funds. When an insured suffers a loss, compensation is drawn from this pool. By pooling or combining the loss experience of a large number of exposure units, an insurer may be able to predict future losses with greater accuracy. From the viewpoint of the insurer, if future losses can be predicted, objective risk is reduced. Thus, thanks to pooling of losses, insurer can reduce risk based on the law of large numbers. The law of large numbers state that the greater the number of exposures, the more closely will the actual results approach the probable results that are expected from an infinite number of exposures. For example, if you flip a balanced coin into the air, the a priori probability of getting ahead is 0.5. If you flip the coin only 10 times, you may get ahead 8 times. If the coin were flipped 1 million times, however, the actual number of heads would be approximately 500,000. Thus, as the number of random tosses increases, the actual results approach the expected results. Second, payment of fortuitous losses. Insurance deals with events that are unforeseen and accidental. It's not for expected or deliberate losses. Fourth, risk transfer. By taking out insurance, individuals and businesses transfer the financial burden of certain risks to the insurer. Indemnification. The goal of insurance is not profit for the insured, but to return them to the position they were in before the loss occurred. In essence, insurance is about community, protection, and planning for the unpredictable. It's a promise of support when life doesn't go as planned. Benefits of insurance include protection from financial loss, risk management, lending requirement, and encourage economic activity. Protection from financial loss is the primary purpose. It provides a financial safety net for unforeseen events. Risk management. For businesses especially, insurance plays a critical role in managing risks that could otherwise halt operations. Insurance provides lending requirement. Many lenders require specific insurance policies, such as homeowners insurance, as a condition of a mortgage. Insurance encourages economic activity. Knowing risks are managed, businesses are more likely to engage in operations and innovations that might carry potential risks. As I conclude, I would like you to leave a comment below how you see insurance playing a role in your life or business. If you found this video informative and thought-provoking, don't forget to hit the like button and share it with your friends. And for more insightful content, don't forget to subscribe to Professor Explains channel. We'll continue to break down complex topics and make them easy to understand. Together, let's journey into knowledge. Until next time, stay curious and informed. Thank you for watching. Keep track of more videos soon. Please like, share, comment, and don't forget to subscribe down below.